Morning. I'm Warren, he's Charlie. We work together. We really don't have any choice because he can hear and I can see. I want to first thank a few people. That cartoon was done by Andy Hayward, who's done them now for a number of years. Andy writes them. He goes around the country and gets voices dubbed in. It's a labor of love. We don't pay him a dime. He comes up with the ideas every year. He's just a terrific guy. He's unable to be here today because his daughter's having a bat mitzvah. But he's a very, very creative fellow. He did something a few years ago called Liberty's Kids. And if you have a child or a grandchild that wants to learn American history around the time of the Revolution, it's a magnificent series. I think it's maybe as many as 40 or so half-hour segments, and it's appeared on public broadcasting. It will be appearing again. You can get it in video form. And like I say, it's just a wonderful way to I've watched a number of segments myself. It's a wonderful way to get American history. The only flaw in it is that the part of Ben Franklin is handled by Walter Cronkite, and Charlie is thinking of suing. It's a little upsetting when Charlie is available. Incidentally, we have Poor Charlie's Almanac next door in the exhibition hall, and it's an absolutely terrific book that Peter Kaufman has put together. And I think it's going to be a seller, a huge seller, long after most books have been forgotten. It's Charlie at his best, and Charlie's at his best most of the time, but it's a real gem. I want to thank Kelly Muchmore, who puts all of this together. I don't give it a thought. Kelly takes charge of this. She works with over 200 people from our various companies that come in and help make this a success. She does it flawlessly. As I mentioned in the annual report, Kelly's getting married in October, so this is just a warm-up. I mean, we're expecting a much bigger event than this come October. I want to thank my daughter, Suze, who does millions of things for me. She puts together that movie. She does draw the line occasionally. A few years ago, we have a dinner at Garot's the day after the meeting, and we were the whole family was there having dinner. The place was packed, and there was a big line that had formed outside. Be sure not to go to Garot's unless you have a reservation tomorrow because they're sold out. But the big line had formed, and it started raining cats and dogs. And a waitress came to me. We were eating. The waitress said, I got to tell you, she said that it's raining like crazy outside, and there's a long line, and Michael Eisner is standing out there getting soaked. So I turned to Suze, and Michael and Jane are friends of mine, good friends, and I said to Suze, why don't you go out there and help them out before they get drenched? And she looked at me and said, I've waited in line at Disneyland. That seems to strike a responsive chord. We've flipped things this year. We're going to have the business session at about 3:15. The plan is to have questions and answers. We have 12 microphones here. We have an overflow room that's filled also, so we've got another few thousand people there. We'll break at noon, and when we break at noon, and anybody that's been in the overflow room that wants to come in here, there'll be, I'm sure, plenty of seats in the afternoon session. We will, as soon as I get through with a few preliminary remarks, we'll go to noon. We'll take a break. You'll have lunch. Many people find that it helps the digestion to shop while you eat. And we have thoughtfully arranged a few things next door that you can participate in while you eat your lunch. And even if it doesn't help your digestion, it'll help my digestion if you shop during that period. During the question period, we can talk about anything that's on your mind. There's 2.5 subjects that we can't talk about. We can't talk about last year's Nebraska football season. We'll correct that next year, but that's off limits. We can't talk about what we're buying and selling. I wish we were doing more of it, but we're doing a little, and I'll make reference to something on that a little later. And finally, in connection with the investigation into the insurance industry practices that's taking place, there are broad aspects of it we can talk about. I can't talk about anything that I or other people associated with Berkshire have disclosed to the investigators, and there's a very simple reason for that. To protect the integrity of any investigation like this, the investigators do not want one witness talking with other witnesses, because people could tailor their stories or do various things. And so witnesses are not supposed to talk to each other. And of course, if you talk, we don't do that. And then beyond that, if we were to talk in a public forum, that could be a way of signaling people as to what you've said, and then they could adapt accordingly. So investigators, one thing they like to do is they like to work fast if they can, because they don't want people collaborating on stories. And to protect the integrity of the investigation, we won't get into anything that's specific to something that I or people associated with Berkshire may have told the authorities. But there may be some broader questions that we can talk about. I can give you a little preliminary view of the first quarter with certain caveats attached. These figures are 10K or 10Q will be filed the end of next week. And I caution you that particularly in insurance underwriting, it's been a better quarter than considerably a better quarter than I would normally anticipate. One of the reasons for that is that our business actually does have the insurance business has some seasonal aspect. Now, it doesn't have a seasonal aspect, particularly at GEICO or at National Indemnity primary business. But when you get into writing catastrophe business, and we're a big writer of catastrophe business, the third quarter, the biggest risk we write in the big cat area is hurricanes, and those are concentrated. They're actually concentrated in the month of September. In this part of the world, 50% of the hurricanes roughly occur in September, and about maybe 17.5% in October and August, and the balance maybe in November and July. But there's a concentration in the third quarter. So when we write an earthquake policy, when we write a hurricane policy, for example, we may be required to bring the earnings in monthly on the premiums, but all of the risk really occurs, or a very great percentage of it, late in the third quarter. And we don't have any risk in the first quarter of hurricanes. So we earn some premium during that quarter that really has no loss exposure, and then we get that in spades come September. Even allowing for that, we had an unusually good quarter, and I would still stick by the prediction I made in the annual report, where I said that if we don't have any really mega catastrophes, I think we've got a decent chance of our float costing us zero or less this year, which means in effect we have $45 billion or so of free money. In the first quarter, our insurance underwriting years are pre-tax. Our insurance underwriting income came to almost $500 million, which was about $200 million better than a year ago. And GEICO had a very good quarter for growth. We added 245,000 policyholders, which is almost 4% in one quarter to our base. We were helped very much by that, by this huge reception we're getting in New Jersey, because we weren't in there a year ago. So we're getting very good sized gains there. We're not getting 4% in a quarter from around the country, but the boost from New Jersey took us up to that. And GEICO actually wrote at a 13% underwriting profit in the first quarter, which is considerably better than we expect over the full year. And we've reduced rates some places, and it's been an extraordinary period for auto insurers generally. But all of our companies in the insurance business did well in the first quarter. Our investment income was up something over $100 million pre-tax. Our finance business income was up maybe $50 million pre-tax. Mid-American was about the same. And all of our other businesses combined were up about close to $50 million pre-tax, led by Johns Manville had the biggest increase. That business is very strong currently. So if you take all of our businesses before investment gains, which I want to explain, if you take them all before investment gains, our pre-tax earnings were up $400 million or a little more. Now, investment gains or losses, we don't give a thought as to the timing of those. We take all investment actions based on what we think makes the most economic sense. And whether it results in a gain or a loss for a quarter is just totally meaningless to us. A further complicating factor, slightly complicating factor, is that certain unrealized investment gains or losses go through the income statement, whereas others don't. That's just the way the accounting rules are. Our foreign exchange contracts are valued at market really every day, but you see it at quarter end. And those foreign exchange contracts, which total about $21 billion now, a little more than $21 billion, had a mark-to-market loss of a little over $300 million in the first quarter. And they bob up and down. I mean, sometimes they bob as much as $200 million or more in a single day. And those mark-to-market quotations run through our profit and loss statement, whereas if we own some Coca-Cola stock and it goes up or down, that does not run through our income statement. But with foreign exchange contracts, it does. So there's a $310 million mark-to-market. It shows as realized. It actually isn't. Investment loss on that. And overall, the investment losses, including that 310, came to about 120. In other words, there was 190 million or something like that in other gains. As I say, that means, at least to us, that means nothing. And to underscore that point, if later in the year the Procter & Gamble Gillette merger takes place, we are required under accounting rules, when we exchange our Gillette for Procter & Gamble stock, we are required under accounting rules to show that as a realized gain. Now, that will show up as probably $4 billion. We haven't realized any gain at that time, in my view. I mean, we've just swapped our Gillette stock for Procter & Gamble stock, which we expect to hold for a very long time. So it's no different in our view than if we'd kept our Gillette stock. But the accounting rules will require that. So if in the third quarter of this year the P&G Gillette merger goes through, you will see this very large supposed capital gain recorded in our figures at that time. And I want to assure you that it's meaningless. And you should ignore that as having any significance in terms of Berkshire's performance. So first quarter's gone by. We've got a good start on operating earnings this year. We won't earn at the rate of the first quarter throughout the year, in my view. I think it'd be very unlikely in terms of operating earnings. But the businesses are performing generally. One other thing I should mention, and then we'll get on to the questions, that we can't announce the name because it isn't quite complete in terms of the other party, but we will probably announce very soon an acquisition that is a little less, somewhat less than $1 billion. So it's not a huge deal in reference to Berkshire's size, but it is in the insurance field. I mean, we love the insurance business. It's been very good to us. We have some terrific managers in that field. You'll see it in the first quarter figures, but you'll also see how we feel about the business by the fact that this acquisition, which I would say is almost certain to go through, will probably get announced in the next few weeks. We're looking for bigger acquisitions. We would love to buy something that cost us $5 or $10 billion. Our check would clear, I assure you. I think we ended the quarter with about $44 billion of cash, not counting the cash in the finance operation. So we're at the moment we've got more money than brains, and hope to do something about that. The microphone that is live, people can line up to get their questions asked. I think we've got 2 microphones also in the overflow room, and like I say, after lunch everybody should come in here, because there's enough people that get so enthralled with shopping that they don't return. They'd rather shop than listen to me and Charlie. And we'll have plenty of seats for everybody in this main hall after lunch. And so with that, let's go to have I forgotten anything, Charlie?
No.
Okay. That may be the last you hear from me. You never can tell. But we'll go to microphone number 1, please.
Simon Dennison Smith from London. You talk a lot about the importance of selecting terrific managers. I'd just like to understand what your 3 most important criteria for selecting them and how quickly you can assess that.
Yeah, I'll give you two different answers. The most important factor, subject to this one caveat I'm going to give in a second, is a passion for their business. We are frequently buying businesses from people who we wish to have continue managing them, and where we are in effect monetizing a lifetime of work for them. I mean, they've built this business over the years. They're already rich, but they may not be rich in a liquid sense. They may have all their money or a good bit of it tied up in the business. So they're monetizing it. They may be doing it for estate reasons or tax reasons or family reasons, whatever. But we really want to buy from somebody who doesn't want to sell. And they certainly don't want to leave the business. So we are looking for people that have a passion that extends beyond their paycheck every week or every month for their business. Because if we hand somebody $100 million or $1 billion for their business, they have no financial need to work. They have to want to work. And we can't stand there with a whip. We don't have any contracts at Berkshire. They don't work, as far as where I'm concerned. So we hope that they love their business, and then we do everything possible to avoid extinguishing or in any way dampening that love. I tell students that what we're looking for when we hire somebody beyond this passion, we're looking for intelligence, we're looking for energy, and we're looking for integrity. And we tell them if they don't have the last, the first 2 will kill you, because if you hire somebody without integrity, you really want them to be dumb and lazy, don't you? I mean, the last thing in the world you want is to be smart and energetic. So we look for those qualities. But we have generally, when we buy businesses, it's clear to us that those businesses are coming with managers with those qualities. And then we need to look into their eyes and say, do they love the money or do they love the business? And if they love, there's nothing wrong with liking the money, but what it's really all about is that they built this business so they can sell out and cash their chips and go someplace else. We have a problem because we're 15 people at headquarters, and we don't have anybody to go out and run those businesses. So it's necessary that they have this passion, and then it's necessary that we do nothing to, in effect, dampen that passion. Charlie?
Yeah, the interesting thing is how well it's worked over a great many decades and how few people copy it.
Go to microphone 2, please.
Good morning, Warren and Charlie. My name is Walter Chang, and I'm from Houston, Texas. Can you describe how you made your investment decision to invest in Anheuser-Busch and how you estimated its intrinsic value? How long did it take you to make this decision? And is Budweiser inevitable like Coca-Cola?
I'm still drinking Coca-Cola. The meeting might get a little exciting if we were drinking Bud here. We don't get into much in the way of description of things we might be buying or selling, but the decision takes about 2 seconds. But I bought 100 shares of Anheuser I haven't looked it up, but I would say maybe 25 years ago when I bought 100 shares of a whole lot of other things. And I do that so I can get the reports promptly and directly. You can get them through your brokerage firm, but I've found that it's a little more reliable to put the stock in a direct name. So I've been reading the reports for at least 25 years, and I observe just generally consumer habits. And at a point, currently, the beer industry sales are very flat. Wine and spirits have gained in that general category at the expense of beer. So if you look at the industry figures, they're not going anywhere. Miller's has been rejuvenated to some degree. So Anheuser, which has had a string of earnings gains that have been quite substantial over the years and market share gains, is experiencing, as they've described, and they just had a conference call the other day, is experiencing very flat earnings, having to spend more money to maintain share, in some cases having promotional pricing. So they are going through a period that certainly less fun for them than it was the case a few years ago. And it's a fairly easy to understand product, and consumer behavior is fairly easy to understand. It's a very, very exceptionally strong business. In fact, what's happened in the beer industry over the last 50 years has been fascinating to me and to Charlie, because this is a brewing town that we grew up in, and Charlie knew the members of the Storrs family, a number of them well. Storrs had over 50% of the Omaha market in beer post-World War II, and basically disappeared as the national brands took over. So it's an interesting phenomenon. Beer business is not going to grow significantly in the U.S. Worldwide, beer is popular in a great many places, and Anheuser will have a very strong position in it, but I would not expect the earnings to do much for some time. But that's fine with us. Charlie, you?
Yeah, at our scale of operation now, if we're ever going to buy into a terribly well-regarded company, we almost need a little patch of unpleasantness.
Yeah. That's been the best time to buy Berkshire, incidentally, too. I mean, we do what we're looking for is businesses with a durable competitive advantage. I don't think there's any question that Anheuser has a very, very strong consumer position. Now, as I said, Miller has been rejuvenated to some degree, but the other thing about it is, of course, in beer you do not see the prevalence of private labels or generic products that you see in a great many consumer products that have had strong positions over the years that are being attacked. So that's a small plus. But beer consumption per capita is going no place, and there's nothing that will change that. Interestingly enough, the average person in this climate drinks about 64 ounces of liquid a year, And I think it's roughly 27% of that will be carbonated soft drinks. So almost, and of course that Coca-Cola will be about, Coca-Cola products will be 40 odd percent. So of the 64 ounces of liquid that Americans are drinking every day, you can figure something like 11 ounces of that, man, woman, and child, will be a Coca-Cola product. Beer, as I remember, I could be wrong on this, but I think beer is about 10% of all liquids. So 1 out of every 10 ounces that's consumed by Americans of any kind of liquid is, I believe, is beer. Coffee, incidentally, despite what you read about, the popularity of Starbucks, which is very real, of course, but coffee has just gone down and down and down over the last 30 or 40 years. Charlie, do you have any thoughts about your consumption habits that you can talk about?
Well, there are people here that may remember Metz beer, and in this country we had more breweries. There were hundreds, and small places would have 2 or 3 brands. And this trend toward concentration into a few giants is, I think, permanent.
Yeah, Schlitz was number 1, as I remember, after World War II for a while. I think Anheuser was number 4 at that time. There's an interesting book, if you're a beer enthusiast, came out a few months ago, maybe a little longer than that, by a Wall Street Journal reporter that sort of toured the country sampling beers. I don't know how it affected his writing, but it's a pretty good book if you like reading about the history of beer. Let's go to number 3.
Greetings from Bonn, Germany. I'm Norman Rentrop. Thank you for another great year added to your track record of investing. And thank you again for allowing us to be partners at these favorable terms. This year, I want to ask you another question about how you see Berkshire positioned versus others. Last year, I asked you how you see the increased competition for buying companies through the rise of the private equity industry and how that affects Berkshire's ability to buy great businesses at fair prices. And you basically said that there are still enough business owners who would rather sell to Berkshire versus a private equity fund. This year, I would like to hear your views on the hedge fund industry. We see hedge funds going into all investment strategies. We know that you have spoken about the fees of the hedge fund industries, but I would like to hear from you how you see Berkshire positioned. Are returns in strategies like merger arbitrage, like convertible bonds, are returns going down because of the increased competition? And are there other factors where Berkshire can be unique versus the hedge funds?
Well, that's a great question. It's a $64 question. There's no doubt about it that there is far more money looking at deals now than 5 years ago, and they're willing to pay up more for the good but mundane businesses that we've been successful at buying in the past. And you mentioned the private equity firms, and they're bigger than ever. The hedge funds have gotten into the game to some degree, and if someone is auctioning off a business today, this has changed just very slightly in the last 4 or 5 weeks because of some change in the junk bond market, but not in any significant degree. There were people lined up to bid on almost anything. In fact, you have private equity firms selling their businesses to other private equity firms, and there are a lot of companies that are being sold to someone who's buying them to resell in a fairly short period of time. We can't compete in that field, and that's a source of distress to us, but that's the way it is. It won't go on forever in our view. We still occasionally, as this deal I mentioned to you, the party on the other side, and we made a deal that did not go through an auction process. And we see that occasionally, but we don't see it anything like we saw it 4 or 5 years ago. So in terms of the near-term outlook for Berkshire, in terms of doing what it's important that we find it extraordinary, both Charlie and I have over the decades, just how fast things can change. There have been at least 3 times, maybe more, where it's looked to me in my own career where it looked like there was so much money sloshing around that it would be impossible to do intelligent things with money. And I actually terminated a partnership back at the end of 1969 because I felt that the money was coming out, of the woodwork. There were all kinds of people that wanted to use it and compete, and I just didn't feel we could do intelligent things. Within 4 years, I saw the greatest opportunities that I've ever seen in my lifetime, and we've had several experiences like that. In 1998, when long-term capital management got in trouble in the fall of 1998 and other things were happening, you had incredible opportunities available in the investment world. Now, people were just as smart then. They had all these people with 150 IQs running around, and they actually had money. But the world became paralyzed for a short period, and you literally had so-called on-the-run governments, which were the most recent issue, and off-the-run governments, which were issued by the same government, the United States government, payable in dollars. You had a 30 basis point differential between the 30-year and the 29.5-year. Both bonds issued by the U.S. government, 1.5 a year shorter, both quite liquid, but the on-the-run being more liquid. And a 30 basis point differential in yield means about a 3-point difference in price. Well, you wouldn't have believed that could happen in the United States of America in 1998, but it did happen. And I think I have a slide here, Mark, if we can put that up, that shows what high-yield bonds, the situation in those, just really less than 3 years ago, in the fall of, there it is, in the fall of 2002, you had all these high IQ people in the financial world. You had lots of money, and I don't know how easy it is to read those figures, but you'll see that a bunch of high-yield bonds, this actually is a table that involves a friend of mine, but we were doing pretty much the same thing. And you can see that he was buying bonds that anywhere from a 25% to 60 or 70% yield basis, and within 12 or 14 months had sold these same bonds on a 6% yield basis. You don't need to do that very many times in a lifetime. But that was 2.5 years ago, after all these people had graduated with MBAs and studied modern finance theory and had money coming out of their ears, and all had a desire to make money, and yet conditions like that could exist. We bought about $7 billion of junk bonds during that period because it was a fairly short period. But things do happen that change the landscape dramatically, I mean really dramatically, in financial markets from time to time. But right now, we are positioned very badly in terms of buying businesses. And it's a big negative. And your Berkshire stock will not do as well under these conditions as it would do if the conditions of 5 years ago or 20 years ago existed. And I don't have any magic solution for that except just to tell you what the facts are. Charlie?
Yeah, a lot of the buying by private equity funds in both real estate and stocks and for companies, fee motivated. In other words, the investment manager will rationalize any price paid. Tried to buy warehouses with a lot of family money, and he just stopped. Whatever he bid was always stopped by some professional manager managing other people's money on a fee basis. So this is a very peculiar era where all these asset classes have been driven to very high valuations by all historical standards. Some investment operations are very ethical in this regard. I think Howard Marks is here today. He sent a lot of money back and stopped soliciting money from his clients in certain activities where the opportunities went away. That's the right way to behave, but it's not normal.
Yeah, I don't think you'll mind. I didn't know Howard was here today, but those actually are Howard's figures for one of his funds. And like I say, we were doing similar things. We didn't know it at the time, but we found out we had some similar positions later on. About 5 or 6 years ago, when the terms of these deals were somewhat different, I actually had a fellow call me whose name most of you would recognize, and he started asking me questions about the reinsurance business because he said he was thinking about buying a given company which got sold, and he didn't really know much about the business, but that unless he spent these X dollars, he was going to have to give it back to his investors in a few months because the term of the initial sign-up period expired at that point, and any unexpended funds were to be returned, and he was going to get 2% a year on those funds regardless of how they did. So he was looking at businesses that he didn't understand with the hope that he could place the money. Charlie and I are at a disadvantage in buying businesses because we have almost all of our net worth in the downside as well as the upside. So, if we had a 2% fee and 20% of the profits and a goodbye kiss for the losses, that's a different equation that exists at Berkshire. So we run it as if it's 100% our money, which it is close to 100% of our net worth, and we will own the downside, and we don't get paid for spending the money. We get paid for making money, and it's tough. Competing right now is tough and likely to be relatively futile, although we have one or two things that could happen that could involve the expenditure of real money.
Yeah, I don't think any of the businesses that have sold to us over the years, which are run by the kind of people we like being associated with, would have wanted to sell to a hedge fund. So there is a class of assets out there that doesn't want to deal with hedge funds or private equity funds. Thank God.
Yeah, we've seen no deal anybody else has made in the last year that we wish we had made. Now, that was not the case 15 or 20 years ago. There used to be plenty of deals made with other people that we would have liked to have made if they'd come to us. But I've seen nothing that if it sold for 10% less than the advertised price that we would have had any interest in buying. So we are in a different world right now. Number 4.
I'm Dudley Schroeder from Council Bluffs, Iowa. When you were younger, what first sparked your interest in investing, and what advice would you give a younger person if they wanted to invest in the stock market? Thank you.
Well, I'm not exactly. I got interested probably when I was maybe 7 or thereabouts. I wasted my time before that. It's a little like W.C. Fields. When he inherited some money, somebody asked him what he did with it, and he said he spent half of it on whiskey and the rest he wasted. So there I was, dawdling around. But I got into, my dad was in the business, so I would go down to his office and I would see these interesting books, and I would read them, and I would go down. He was on the 4th floor of what's now known as the Omaha Building at 17th and Farnham, and on the 2nd floor was Harris Uppelman Company, and they had a board, and I would go down there. The market was open on Saturdays in those days, so I could, for 2 hours, so I could go down on Saturday, and I saw all these interesting things going across the tape, and I just read a lot. I probably took every book in the Omaha Public Library, and every book they had on investing, or the stock market, basically. I was very interested in the New York Stock Exchange. I thought maybe I'd want to become a specialist when I grew up, and maybe I still will. But I took all the books out, I read them, and finally when I was 11, I bought 3 shares of stock, and I didn't know. I was fascinated by the subject. My dad got elected to Congress, so now the library became even bigger, and I took all the books I could out of there on markets, and I used to chart and do all that sort of thing. And then finally I read Graham's book when I was at the University of Nebraska, The Intelligent Investor, when I was 19, and that just changed my whole framework. But the advice I would give is to read everything in sight, and to start very young. It's a huge advantage in almost any field to start young, and if that's where your interest lies, and you start young and you read a lot, you're going to do well. I mean, there are no secrets in this business that only the priesthood knows. I mean, we do not go into temples and look at tablets that are only available to those who have passed earlier tests or anything. It's all out there in black and white. It's a simple business. It requires qualities of temperament way more than it requires qualities of intellect. I mean, if you've got more than 125 IQ, you can throw away the rest of the points or give them to your other members of the family or do something, because you don't need it in investing. But you do need a certain temperament that enables you to think for yourself, and then you have to develop a framework, and I developed it from reading Ben Graham. I didn't come up with it myself. Very simple framework. And then you have to look for opportunities that fit within that framework as you go through life, and you can't do something every day. You can learn every day, but you can't act every day. And I talked about reading the annual reports of Anheuser-Busch for 25 years, but I'd read the reports of Coca-Cola and Gillette and all kinds of companies long before we invested in them. And if you enjoy the game, you'll find that like playing bridge or playing baseball or whatever. And if you don't enjoy it, you probably won't do well on it. But I would advise you to start early, read everything in sight, look for the successful framework that's been successful for people. And there's nothing like Graham's, in my view. And you'll have a lot of fun, and you'll probably make a lot of money. Charlie?
Well, I'm at a little disadvantage here. Warren has made himself into kind of a dean of investors starting as a boy, and he has a greater respect for the process than I do. I have a good bit of Keynes's attitude that money management is sort of a low calling compared to being a surgeon or a lot of other things. I think the corporate types, the corporate managers, ought to study investing better because they'd be better managers. And I think that everyone who thinks about through the investment process learns more about how the world really works. And I think that's very worth having. But I do not like as big a percentage of GDP as we now have going to money management and its attendant frictions. And I don't like the percentage of the nation's brain power that is now in all of these different forms of highly compensated money management. I don't think it's a good thing for the country, and I hate the fact that we've contributed to it by our own predilections.
Charlie is only sitting up here next to me as part of his outreach program, actually. Please don't take any pictures that you could blackmail him with being associated with me. Charlie made a very good point there about how managers could do better if they understood investments. I find it absolutely fascinating, and I've seen this throughout my life. I've seen it close up. I will have friends who are CEOs of companies, and they'll have somebody else handle their money. If you say to them, should you buy Coca-Cola or Gillette or something like that, they'll say, that's much too tough. I don't understand that sort of thing. What do I know about investing? And then some investment banker will walk in the next day with the idea they buy a $3 billion company, which is just buying a lot of shares of stock of one company. And they'll run through some little 2-hour presentation and turn it over to a strategic planning group and think that they are then the ones that should make that decision as to whether to buy multi-billion-dollar businesses when they really don't feel they're qualified to make $10,000 decisions with their own money. And it's extraordinary what you see in corporate America in the acquisition activity. It's not, it's you know, it's a little like they say about making sausage and making laws. It's better unobserved. Charlie, you have any further thoughts on that? You've seen a lot of it with me.
Well, I do think that the present era has no comparable precedent in the past history of capitalism. I think we have a higher percentage of attention of our intelligent classes into buying little pieces of paper and trying to get rich doing it, and in promotional activities with big profit sharing fees. I can recall no past era which had a similar concentration of this type of activity. Can you, Warren?
No, but I think you would say probably too that when we've seen sort of baby versions of this, something subsequently happened. That
oh yes, if you want to talk about what are the future implications, a lot that I see now kind of reminds me of Sodom and Gomorrah. And
we weren't there, incidentally. I mean,
no, but there's a published account, and I think when you get as much sort of regrettable activity going on and sort of feeding on itself in frenzies of envy and imitation, that it has happened in the past that there came bad consequences.
On that cheery note, we'll move to number 5.
Good morning. My name is Molly Fenner. I'm 11 years old and I'm from Long Island, New York. I have 2 questions today and I have put them in the form of a poem. Mr. Buffett, Mr. Munger, to get here we had to fly. I came to hear your thoughts if PetroChina was at an all-time high. My second regards a job that I know is just right for me. To be a seeds candy taster, my sisters and I would work for free.
Well, if you come up front, I'll put you to work.
Oishams was for my mom, and my father loves his stock. I have a future tasting chocolate. This weekend has really rocked. Thank you very much. And really, what is your view on PetroChina?
If you come up at the break, Charlie and I will have taken all the pieces out of here that we like best, and you will get the rest. No. Charlie, do you have anything to add to that?
She wants to know what you think about PetroChina.
It's funny. I saw her out there in the shopping area, and I knew that she had PetroChina on her mind. We bought PetroChina a few years ago, again after reading the annual report, and fortunately it was in English. It was the first stock, Chinese stock, and really the last. I mean, it won't necessarily be the last, but I mean it's the only one that we've owned so far. We put about $400 million into it. At the time, and still, it produces about 3% of the world's oil, which is a lot of oil. It produces probably 80% or so as much as ExxonMobil will produce. And it's a huge company. Last year it earned $12 billion. Now, if you look at the Fortune 500 list, my guess is you won't find more than about 5 companies in the United States that earn $12 billion or more. So it's a major company. At the time we bought it, the total market value was $35 billion. So we bought it at about 3 times what it earned last year. It does not have unusual amounts of leverage. In the annual report, they say something which very, very few companies do say, but which I think is actually fairly important. They say they will pay out about 45% of the amount they earn. So if you can buy it at 3 times earnings, what turned out to be 3 times earnings, and you get 45% of 33%, you're getting a 15% yield on your cash yield on your investment. It's a very good annual report. Chinese government owns 90% of the company. We own 1.3%. If we vote with them, the two of us control the business. And it's a thought that hasn't occurred to them, but I'll keep pointing it out. But it's a very major business at a very, very attractive, at what was a very attractive price. Unfortunately, the government shares and our shares have the same economic interest, but they are classified differently, so that the government's 90% are called one thing and the 10% with the public are called 8 shares. And we have to report in Hong Kong when we own 10% of a company, or we did then, 10% of a company's shares. So unfortunately, the 10% applied only to the 10% of 8 shares, and so we had to reveal our ownership when we only had 1% of the economic interest in the company. So we would have bought more, but the price jumped up, and we are happy to have our 1.3% or whatever it is, and we think that they've done a good job in running the business. They've got large gas reserves, which they're starting to develop now. But it's a very major enterprise. It employs almost 500,000 people. And the interesting thing was, a few years ago, relatively few people in the investment world probably even thought about the fact that PetroChina was over there and was a much larger business than most of just about any oil company in the world, except for BP and ExxonMobil. Charlie, do you have any thoughts on that?
Yeah, it would be nice if this sort of thing happened all the time, but that hasn't been true in recent years.
But I should emphasize, the annual report of PetroChina, which, like I say, it's easy to read, understandable, they declare their policies. Anybody could get it. You can read it. We did not go over, and we never had any contact with the management before we bought the stock. We'd never attended an investor presentation or anything of the sort. It's right there in black and white in a report that anybody can get. And we just sit in the office and read those things, and we were able to put $400 million out that's now worth about $1.2 billion or something like that. It was interesting at the time. I think I'm right on this. At the time, Yukos, which is the big oil company in Russia, was probably far better known among the investment community in the United States than PetroChina. And I compared the two at the time, thought to myself, would I rather have the money in Russia or have it in China? PetroChina, in my view, was far cheaper, and I felt that the economic climate was likely to be better in China. Would I have, if it had been selling at the same multiple as a U.S. domestic company, would I have regarded as more attractive? No. There's some disadvantages always to being in a culture that you don't perfectly understand, or where tax laws can change, your ownership rules can change. But the discount at which PetroChina was selling compared to other international oil companies was in my view at the time ridiculous. So that's why we bought it. And we will have the candy available for you at the break. Number 6.
Good morning, gentlemen. My name is Matt Sauer, and I'm from Durham, North Carolina. Many businesses are reporting rising costs and surcharges on such inputs as fuel, metals, and wood. They are often unable to pass along these costs to their consumers. If commodities stabilize at price levels above those of the past decade, will corporate margins be compromised into the future?
Well, it's a great question, and I would say that would depend very much on the industry you're talking about. But in our carpet business, for example, we've just been hit time after time, as I mentioned in the annual report, with raw material increases because there's a big petroleum derivative factor there. And we have lagged in terms of being able to put through those increases to our customers simply because we want to protect the Nebraska furniture marts, or those that have ordered for a reasonable period of time, and that's squeezed margins in carpet. We use lots of natural gas at Johns Manville, use lots of natural gas at Acme Brick, and that's tended to squeeze margins some. I think over time, I think there has been a lot more inflation in these basic materials. Steel has been off the chart. I think over time, the businesses with strong competitive positions manage to pass through increases in raw material costs just as they pass through increases in labor costs. But you get these temporary situations where sometimes the costs are increasing faster. I don't think the American industry, I mean, a higher cost for oil when we import 10 million barrels a day or more of oil, if we're paying $20 or so more per barrel than we were a year or two ago, that's $200 million a day is a tax. But it's more of a tax on the American consumer probably than on American business. The American business will probably be able to pass through most of those raw material cost increases. It is worth pointing out that corporate profits as a percentage of GDP are right at the all-time high, leaving out a few aberrational periods. And I would, if I had to bet on the direction of corporate profits as a percentage of GDP over the next 5 years, I would bet they would go down somewhat. But that's because they're right at this very high level. Interestingly enough, while corporate profits as a percentage of GDP are at this very high level, corporate taxes as a percentage of total taxes raised in America are very close to an all-time low. So American businesses managed to pull off a situation where they're making extremely good profits and paying a very small percentage of the total tax bill as measured in this country historically. And I'm not sure whether that could or should or will continue. But it's a very, very favorable period right now for corporate America. But that's nothing to get bullish about, because you might expect something of a reversion to the mean. Charlie?
Well, I can't add to that, but I can restate it. It's hard to know just which companies can pass through the increases in costs that come from higher commodity prices, and it's also important to know.
We like buying businesses where we feel that there's some untapped pricing power. We haven't been able to do much of that lately. But back in 1972, when we bought See's Candy, I think it was was it $1.95 a pound?
Something like that.
Yeah. And they were selling 16 million pounds of candy a year, making $4 million pre-tax with about $25 million purchase price, which I would have very foolishly refused to budge on, and in history have cost us a lot of money. But one of the questions we asked ourselves, and we thought the answer was obvious, was, if we raised the price 10 cents a pound, would sales fall off a cliff? And of course, the answer, in our view at least, was that no, there was some untapped pricing power in the product. And it's not a great business when you have to have a prayer session before you raise your prices a penny. I mean, you were in a tough business then. And I would say you can almost measure the strength of a business over time by the agony they go through in determining whether a price increase can be sustained. And frankly, a good example of that is the newspaper business right now, because 30 years ago, when whatever the local daily would be had a